Hello and welcome to Market Domination. I'm Josh Lipton, live from our New York headquarters. There's just an hour to go until the closing bell here, and stocks off session lows as oil pairs gains. Polymarket bettors, by the way, expect oil prices to remain over $100 a barrel through the end of the month. Joining now to help us make sense of the latest market action are our very own Inez Ferre and Jake Conley. Welcome both. Jake, I'll start with you. Why don't we start, listen, energy prices moving higher. You had this Iranian attack on a key LNG export facility in Qatar. What do we need to know about that?
Yeah, that's right. This war really has evolved from military targeting to energy infrastructure targeting over the last few days. Really, it started with a strike by Israel in the South Pars gas field in Iran. This is part of the largest natural gas field in the world. Iran immediately came back, published a target list, and said, we need to see evacuations. We are going to strike. They have now done so. One of those strikes was on this LNG export terminal in Qatar called the Las Rafin export terminal. It's the largest LNG export terminal in the world, handles about a fifth of all global LNG trade. So this is a major, major hub. You've seen natural gas prices, especially in Europe, already spiking. Today, Qatar Energy, the company that runs that terminal, saying that it suffered, quote, extensive damage and that they might have to declare force majeure on shipments as far as 5 years out from now because the repairs could be 5 years long. So this is a really firm step up in this conflict. I want to call out as well, we keep talking about where are the off-ramps for this? The Strait of Hormuz is blocked off. What other options do these producers have to get oil out of the area? Are there pipelines? There is one very prominent pipeline that runs across Saudi Arabia called the East-West Pipeline. It goes out into the Red Sea, which means you could get oil out into the market. Saudi Aramco just stopped loadings on the Red Sea because of an Iranian attack in the area. So this is just getting more and more widespread and really putting a real threat on the long tail of this, and not only transit, but the actual supply coming out of the ground, going out to the market.
You made a really important point there, Jake. Just this move that we've made here from traffic disruption, right, in the Strait of Hormuz, to now physically attacking energy infrastructure. Walk me through that and the potential market implications of that.
Every strategist I talk to says the market implications of this, it's really, really large because this is a long tail. These kind of repairs on these facilities, these are really hard to repair. Parts are really rare. This is billions of dollars in infrastructure. The tail of this is likely to be not measured in months, but years of repairs now. And all of that is going to slow down production. It's going to slow down capital investment. It's going to slow down flows over time. And that could really keep prices depressed. Goldman out today, this is not their base case. Their base case is lower than this, but they're saying that if the market keeps worrying about these disruptions, if it keeps looking like disruptions are going to be happening for longer, you could see Brent cross its 2008 all-time high of about $147 a barrel. Right now, we're trading at about 110.
And as another headline, I want your take on Trump administration telling oil industry execs today it has now ruled out banning oil exports as a way to bring down energy prices. That's per Politico. What did you make of that?
Yeah, look, virtually everybody across the industry is saying that it would be terrible if they did do some type of export ban. You've got Goldman that's saying that it's not their base case that they would, but if they did, they may do it on refined fuels. I just spoke to a strategist that said that would kill the refineries businesses because their margins are so thin. So it's obvious that the administration does not want oil prices to be this high. The fact that President Trump yesterday had put out that Truth Social talking about that energy target in Iran, I thought was very interesting because he's basically saying, I don't want this to go into the energy infrastructure. And that is the red line that we were just talking about.
But then you see him say that if Iran continues, there will be massive U.S. attacks on the South Pars gas field, ratcheting up the tension even higher.
Yeah, that was interesting back and forth on social media. Inez, switching gears here from oil to gold, which you wrote about today. Gold, you think of course, is sort of the ultimate safe haven, right?
Yes.
Why is it falling?
Look, that safe haven has lost its luster during this war, because if you take a look at gold prices, they are down about 12% since the war began. You've got headwinds, and that is mainly that you have central banks that are going to hold rates steady and even possibly hike. I mean, you're talking about now there's officials over in Europe that are talking about possible hikes. This is not good for gold, because when you've got higher yields, this makes gold that is non-yield bearing less attractive. And then you've got the dollar that's been moving up. So again, this is also a headwind for gold. Yes, you have investors that are selling their best performing assets, but for the time being, it is not having the reaction that it would when you are in a war. I mean, you think of it as a safe haven. I will say that getting past this, if the dollar goes too high, it starts breaking things. And namely, it also is not good for the bond market as well. So the dollar cannot go too high. At some point, there is going to be some maneuvering to get the dollar lower. And so therefore, that's the case that strategists are making, that longer term, you're going to see this turn around. But for the meantime, yes.
Can I just ask you, only because we talk so much about it, that's gold. What about silver?
Silver has been much more volatile. Same situation, though, when you talk about the metals in general that are in dollars. But yes, silver is a little bit more of a volatile. It's not the same play. Strategists are not putting this in the same. It's much more speculative, and they're not putting it in the same scenario. You also have a lot of buying that took place with silver in Asia. So we'll have to see how that transpires going forward. But I'm not seeing calls that silver is going to go to its all-time high again anytime soon. I mean, that's more speculative.
And to pick up on Inez's point, you see the same thing on the industrial side of the metals complex. Copper, as of this morning, just gave up its all-time highs for the year. All of the year-to-date gains are now gone as of this morning because copper has fallen so hard. Why is that? Copper typically trades as a proxy for industrial expectations. If you expect growth, copper does well. Right now, what are we seeing? Really lower expectations going forward for growth. People are worrying about industrial growth, industrial demand, so copper is going to suffer. At the same time, as Inez was talking about with the Fed, if the Fed keeps rates higher for longer, if the yields are higher, that's not going to be good for commodities that typically move the other way. So copper's going to suffer there. And if you just keep seeing more and more of this demand destruction, because people don't see the growth, the industrial metals are going to hurt too.
And that's a good point on the industrial side of this. Again, also with silver as well, which is seen as an industrial metal as well. So you are seeing that there are fears of demand destruction that is going to happen.
Finally, Inez, before we let you go, you talked about gold. What about digital gold? Although Rich Bernstein told me on the show, don't call Bitcoin that. Tell me that very clearly. No digital gold. So let's just call it Bitcoin. What's going on with Bitcoin?
I mean, look, Bitcoin was very resilient for a large part of this month. I mean, when you take a look at what's been happening with the war and Bitcoin, but it's below 70,000. You have strategists that are saying that, yes, if the Fed hikes, or if the Fed holds steady, maybe if the Fed hikes later, we don't know. But that's certainly in play here as well. I mean, you are looking at the entire macro picture and what is going to happen now that there's a more hawkish feeling, so to speak, on the street.
And let's just point out today, Macquarie strategists came out and doubled down on their call for a potential rate hike from the Fed in the first half of 2027, pointing to some of Powell's more hawkish comments yesterday. If they say if there's going to be a move, that's not just a hold, it's probably going to be a hike at this point in the first half of next year. That's a radical change from what we would have thought 6 months ago. Again, I do not want to be Jay Powell right now.
Jake and Ez, thank you both. Appreciate it. And you can scan the QR code on your screen to go to the Yahoo Finance Prediction Markets Hub powered by Polymarket. Let's focus on the oil markets as those strikes we just spoke about on energy infrastructure are putting increasing pressure on prices. Joining me now, we've got Jacques Rousseau, Clearview Energy Partners Managing Director of Oil and Gas. Jacques, it is good to see you. So listen, energy prices moving higher. Let's start with that strike by Iran, Jacques, on that key LNG export facility in Qatar. What kind of impact do you think that has, Jacques? How much production can be offline and for how long?
So the facility is very significant. There's three major global LNG producers. There's the United States, there's Australia, and there's Qatar. Qatar was 19% of global trade last year. So when the war began, they just shut the facility down. They said, we don't want to take any risk, and the cargoes couldn't get through the Strait of Hormuz anyway. What happened yesterday was the strike on it, what the company's saying, knocked out 17% of capacity for 3 to 5 years. So pretty significant. The one caveat to think about, though, is that this happened entering spring. Global gas demand is very seasonal. The world uses about 30% more during the winter than the summer months. So that's the one break that's probably prevented gas prices in Europe and Asia from going higher.
You know, Jacques, we talked about this kind of how things seem to have escalated, right? We were talking about blocking supply routes, the Strait of Hormuz. Now we've moved to, really attacking physical energy infrastructure. I'm curious, as an analyst, how do you think through that? How do you think about the potential market implications of that?
Well, the one way to look at it is to look at the futures curve. So if you look at the Brent prices, before the war, Brent was trading in December of this year. So let's just use the end of the year. End of the year, Brent was trading at $70 a barrel. Now it's trading at 85. So people are starting to view this as a longer lasting situation. And it's exactly for the reason that you said, is that we're getting assets that are getting damaged. It's one thing if the strait gets cleared, it'll take, weeks, maybe a month to get flow back to normal. But if assets are damaged, it can take a lot longer.
Another topic I want your take on, Jacques. You did see Trump waive the Jones Act to try to curb oil prices. One, what kind of impact do you see that potentially having? And two, do you think that 60-day waiver could turn into something more permanent?
Well, I guess the way you look at it in the U.S. is that the situation here isn't as dire because the U.S. is a net exporter of petroleum. We still import more oil than we export, but we export a lot of refined products. And so I think with the Jones Act, you're talking about just being able to move things around regionally a little bit more, which will help. But, the big issues that are going on is just the oil price being high, and then that translates into a higher gasoline price in the U.S., which is getting everybody's attention.
Yeah, I want to come back to that, Jacques. But first, just broadly, you're looking at Brent here at 107. Do you look at that level and say that makes sense, Jacques, or no, that is underappreciating risk?
That's a good question. So if we take a look at what the picture was before the war, it was a significant amount of oversupply. We were tallying at about by 4 million barrels per day in the month of March. And now we're looking at a significant amount of undersupply, probably about 5 million barrels per day in the month of March. So you can see this massive swing in oil that's disappearing because it can't get out of the strait. And so to answer your question, I think the longer this goes on, the longer it justifies higher oil prices. It doesn't appear, to me at least, that you're seeing any sort of resolution on either side to slowing down the war. So there's going to have to be some other method. Somebody else will need to step in and try to broker a deal between the U.S. and Iran. Otherwise, this could go on for a long time.
So, Jacques, when your clients ask you, okay, what's base case for oil near to intermediate term, what are you telling them right now?
Well, I think at this point, we thought the oil price was being underappreciated over the past few weeks because this disruption is massive. It's very significant. As your colleague was saying before, there's only a few other ways for Saudi Arabia, United Arab Emirates, and a little bit from Iraq to move oil in a different direction. So there is just a massive amount of oil that's coming off the market. It doesn't take hold right away because countries can fill up their storage with inventories, but we're hitting the point where storage is getting filled, and now you're starting to see more and more oil get shut in because it's the refined products are getting shut in, so we don't need to produce as much as at the refineries. So what we're going to see is that unless there's some sort of way of de-escalating this war, oil prices are going to stay high for a while.
What does that mean then, Jacques, for product prices, diesel, jet fuel? What do you see ahead?
Well, the only diesel, definitely very, very strong prices. Jet fuel, you have seen an issue where there's been a big drop in jet fuel consumption in the Middle East because of the fact that no one's really flying. So that has impacted that. But yes, all refined products are going up. And obviously for the U.S., we're hitting into the peak gasoline consumption season. And so that's not good. The situation is not going to do any favors for U.S. gasoline prices.
How much, Jacques, does Brent impact the price of what we as Americans pay at the pump?
Well, if you take a look at the market, there's probably about a $10 difference in Brent and WTI. So there is a benefit for U.S. consumers, but Brent prices still impact more of the coastal markets because especially at the East Coast, they're not using WTI as a price marker because WTI is in the Midwest.
Final question, Jacques. Let's say you could get traffic to return to normal levels of the Strait of Hormuz. Even if you did that, I'm just curious, what is the timeline there, for full resumption? Would it be, in your opinion, days, weeks, months?
It would be weeks to maybe a month, because if you take a look at it now, there's been about, let's just say it goes through the end of March. There'll be a whole month where ships are not leaving the Strait. Well, it takes, 30, 45 days for these ships to get to their destinations in Asia. So, there's a big hole that's in that whole system. So it'll probably take at least a month to get things back to normal.
Jacques, appreciate your time today. Thanks so much.
Thanks. Good to be here.
Coming up, we look at what rising crude oil means for prices at the pump here at home.
The implications of events in the Middle East for the U.S. economy are uncertain. In the near term, higher energy prices will push up overall inflation, but it is too soon to know the scope and duration of the potential effects on the economy.
Gas prices are moving amid escalation in the Middle East. The national average now sitting just under $3.90 a gallon. Our next guest warning we could be looking at $4 gas soon. Joining me now is Patrick DeHaan, head of petroleum analysis at Gas Buddy. Patrick, always great to see you. So let's just start right there. So you're calling for $4 gas soon. First, define soon, I guess, Patrick. When is that? And then do you see that as, okay, that's a short-term spike, or no, Patrick, that's something more sustained?
Well, you know, a lot of this, by the way, is in mind of what's happening. As long as we don't see any meaningful change in the Strait of Hormuz, I think $4 a gallon is a realistic possibility by next week, by late next week. We'll have to see if there's any de-escalations between now and then. I don't think it'll be permanent. To the president's point, this is temporary, but any increase in the price of oil to this degree is usually temporary. These geopolitical tensions will eventually cool. Oil prices may recede just depending on the degree of de-escalations and what that all looks like. So I hope it's not going to be here for a longer period of time, but it certainly could be.
Patrick, how much could the U.S. cushion through SPR releases or maybe other policies?
Well, you know, there's a lot of small levers the president has. I think the SPR release from the IEA, which is coordinating with the U.S., some 400 million barrels, you know, it sounds significant. But at the end of the day, think of it as a water main, the Strait of Hormuz and the amount of oil flowing through a water main. And the U.S. and the IEA is trying to replace that with a straw. I mean, that's really what we're looking at. The rate of release is rather low. You know, even under the best estimates, we're talking about a release of 2 to 3 million barrels a day, which still pales in comparison to the 20 million barrels a day affected by the Strait of Hormuz. Now, the Saudis are moving some of that via their east-west pipeline to the Red Sea. There are some loadings that are happening there, but a lot of this disruption, you know, until there's some sort of improvement in the Strait of Hormuz, we're going to continue to see oil, gasoline, diesel, and jet fuel prices all reacting to this new reality. Let's say
there was an end to the conflict, Patrick. I don't know, days or weeks. How quickly would that then filter through to prices at the pump?
Well, it'll start rather quickly. Just what like prices went up within 24 to 48 hours of this situation starting. They'll start going down in 24 to 48 hours after we have some clear resolution. Now, it will take a little bit of time. The national average at the fastest pace we've ever seen has declined 2 to 3 cents on average every day over the course of a couple of months. So it may take a couple of months to fully get back down to where we might be. Keep in mind, though, there is seasonality that's also pushing gasoline prices higher, and that'll continue to prevent a full-on drop to pre-war prices.
Trump did waive the Jones Act, Patrick, to curb oil prices. I'm just curious what you made of that decision. What kind of impact do you think that really does ultimately have?
Well, it certainly has greater impacts for areas like California, where refineries have been shutting down. 2 refineries now shut down in the last 6 months in California. That Jones Act waiver will help refineries in the Gulf Coast send gasoline through the Panama Canal over to California. It will also help areas of the Northeast where refining capacity is greatly restrained. Again, it gives Gulf Coast exporters and refineries far more options. The Jones Act, again, for those that may not be aware, requires or did require until it was waived a U.S. crew of shipments from U.S. ports to another U.S. port with U.S. crew and U.S. flagged vessels. So that usually leads to a higher price. Now that that's been waived, products will move more freely and at slightly lower prices. But for motorists waking up, they're not going to notice a plummet in the pump price tomorrow from that at all.
You mentioned California, Patrick, my home state. I'm just curious, what are the sort of key regional differences you see right now across the country in terms of prices at the pump, where they're highest, where they're lowest?
Yeah, you know, for now, the map behind me shows it pretty well. The Gulf Coast and the nation's interior, where gasoline can't easily be exported, are some of the lowest priced areas. The inland areas, the Great Lakes, are a little bit more expensive because some of those states, Michigan, Illinois, and Indiana, have higher gasoline taxes. But where that gasoline cannot be exported in the nation's interior, you're seeing the lowest prices because the coastal regions now are more susceptible to exports. That is, refineries can simply export it to a global market that is in high demand for gasoline, diesel, and jet fuel. And that's exactly what's been happening, which is driving up prices more in those coastal regions.
I'm curious, Patrick, also, what do you think possibly the impact of all this is on American travel? I mean, spring is coming up, spring break front and center for a lot of folks.
Yeah, I mean, it probably will have a more profound impact on air travel, although I looked at some airfares and they still seem reasonable. One of the airfares I booked for Europe later than summer went up 21%. So I think it's going to depend on the length of the journey. Airlines have already been making it very clear that they're passing along these jet fuel price increases. This could keep Americans from some of those longer haul summer trips, but in the short term, I really don't think that we're at the point yet where many Americans are going to start canceling or shortening their plans, especially when you talk about the summer. Americans are certainly going to gripe about it. We're going to grimace and bear it for now as long as prices don't reach record-setting levels.
Finally, Patrick, remind us, because I'm always curious, what are some of the tips and tricks you're using as you look around right now, try to find the best deal at the price of the pump?
Yeah, I think Americans are resigned to not getting any fuel efficiency gains, but that's probably the easiest area for many of us to get more miles per tank. How do you do that? Watch your foot on the pedal, slow down a little bit on the highway, and stop racing from light to light. That's a great start there. Removing excess weight from your vehicle, removing roof racks that you're not using. Driving habits are a big part of it, but then you mentioned how to find the cheaper gas. Of course, apps like Gas Buddy and Google Maps show you lower prices. Pair that with loyalty programs, credit card rebates. Even Gas Buddy has a payments card that saves some money. Otherwise, cash discounts. There's a lot of different ways to save. If you put them all together, you can save at least 25 or 50 bucks a month.
Patrick, as always, great to see you and have you on the show. Thank you, sir.
Thanks for having me.
Coming up, we dive into what rising oil and gas prices could mean for the health of the U.S. economy.
Consumer, than standing there holding down the gas nozzle and watching the numbers tick on the pump. Every consumer in this country knows exactly what they paid the last time they filled up their tank, what they paid a month ago. And if they were paying $80 a week ago and they're paying $85 this week and they were paying $60 a month ago, they know that I lost $20 of disposable income in filling up this tank of gas.
Fed awaits the economic ripple effects of the U.S. war with Iran after it held interest rates steady yesterday. Let's take a pulse check on the U.S. economy and the next steps for the Fed. Luke Tilley joins me now. He is chief economist at Wilmington Trust and a former economic advisor at the Philadelphia Fed. Luke, always great to see you. So the Fed, of course, held steady. They're signaling just one cut in 2026. But you, my friend, you're calling it, looks like you're, Luke, for three. Now, that's interesting. So what are they sort of missing or maybe misreading, you think, Luke, in all that data?
Yeah, I don't know that they're necessarily missing anything, but this does feel extremely familiar. About a year ago, we had some higher inflation readings, and some people started switching over to thinking they would need to hike rates, and it actually happened 2 years ago, too. And we maintained the view that they would end up cutting rates, and it all comes down to the economic data. And for us, it's really how the labor market is doing is going to end up dominating things. So I don't fault anybody, any of the 19 people on the participant list for the FOMC for being a little bit guarded and worrying about inflation. But the critical thing here is that when you have an energy price shock that's coming from the supply side, if you don't have strong enough demand for consumers, then it doesn't play through to core inflation. And Chair Powell said this yesterday. And I think that probably behind the scenes, they're all thinking that this will end up weakening growth more than it will be driving core inflation, though they have to wait and see how it turns out. But ultimately, we know that the labor market is not really creating any jobs right now for the past 6 months, basically about flat. We expect that to continue, and maybe we even worsen a little bit. And we expect the unemployment rate to rise, whereas the median member of the FOMC has the unemployment rate at the same place at the end of this year that it is right now at 4.4%. So fundamentally, it comes down to we're a little bit more pessimistic about the labor market, and we also don't think that the energy price shocks are going to flow through to core inflation.
Yeah, so that's what I was going to ask you, Luke. I guess is what you're another way to put this is energy shocks typically don't drive core inflation higher, and you think the Fed risks here kind of overreacting to headline inflation?
Well, I think they're just being cautious. And yeah, energy price shocks can flow through to core inflation. But the critical distinction is an energy price shock really just being driven by a supply side, which is exactly what's happening right now, undeniably, or is it accompanied by strong demand, strong spending, strong consumers? Because when you have strong demand, strong consumers, just like you did in 2004, 5, 6, crude prices were rising then too, but you had a strong consumer, and that drives inflation higher, and that drives the need to cool the economy off. But this is going to end up playing out very similarly, we think, to tariffs a year ago. A year ago, everybody was worried that tariffs were going to drive inflation higher, and we took the position at the time that said, consumers are not in good enough shape to handle these tariff-based increases. They're just going to cut back on their services spending, and services inflation is going to slow down. That's exactly what ended up happening last year, and you saw that reversal through the summer and into the fall by the Fed. And this is essentially the same thing. I mean, for most consumers, you can't avoid gasoline price increases. It functions like a tax, very similar to a tariff. And because we have, kind of normal wage growth and essentially no job growth, this is going to end up weakening the consumer. So I think that they'll pull back on services. They'll pull back on everything other than gasoline, and you end up getting weaker inflation. And that's the critical thing here, and that's what we expect to play out over the rest of this year. On
that labor market, Luke, when Powell spoke about it, it sounded like broadly he was kind of characterizing it as generally stable. You're seeing underlying weakness, though. What are the specific cracks, Luke, you see that we need to be paying attention to?
Yeah, the biggest thing here is that when you take the private sector, so get rid of the government, because the government doesn't react to economic cycles, right? And then so just take all the private sectors. And then if you remove the healthcare sector, the healthcare sector always adds jobs. It doesn't matter what is going on, maybe like 1 month during COVID. But even when Lehman failed and you had a financial crisis, the healthcare sector was adding jobs. It is a secular grower. It does not respond to economic fluctuations. When you take all the other sectors, since the Rose Garden tariff announcements last year in April, all the other private sectors have cut jobs by more than 300,000 in total since April of last year. This is an economy with a lot of uncertainty, a lot of changes, and employers are simply cutting jobs right now. Yes, there is some drag from the fact that we have lower labor force growth, but there's a lot of job cutting going on. There's a lot of people who are looking for a job and they give up. Yes, the continuing claims this morning continue to be low, as we saw this morning, but there's a really high rate of people who are exhausting their benefits and just rolling off. So they're no longer in the continuing claims. And then fundamentally, Chair Powell said yesterday, the February unemployment rate, 4.4%. It really hasn't moved since September of last year. Technically, that's correct. But when I look at it, I see an upward trend. It's been moving up since the end of 2022, basically. And when you've got such low job creation and so many people out there looking for it, combined with higher gas prices, we're expecting to see the unemployment rate creep up. We have it forecasted to go up to 4.8 to 5%, whereas the Fed is forecasting, like I said, at the end of this year, the median forecaster expects it to be unchanged from its November level. And I think they'll be wrong before April or May on that. And they'll start changing their tune when the labor force numbers come in weaker.
On the consumer, Luke, I don't know if you saw this. CBS had a story out. If you didn't see it, I'll read it to you. They were sort of talking about surging gas prices, Luke, and how that could basically really wipe out these bigger tax refunds. And they cited economists at Stanford. I'll read you the numbers. They say the average U.S. household is now going to spend an additional $740 on gas this year. And if that is true, they say, that then basically gobbles up nearly all the additional money people are slated to collect in tax refunds. I was just curious, through the lens of an economist, what do you make of that?
Yeah, it acts like a tax. Most people cannot go out and buy a more efficient car when oil prices spike. So they basically have to deal with it. You can change your transportation habits a little bit, but it takes away from your ability to spend on other things. And that report is doing it sort of on an individual household basis, which is definitely one way to look at it. Another way to look at it is the macro. So if you think about the new tax cuts in the One Big Beautiful Bill Act, so overtime and tips, expanded child tax credit, all of those things, the estimates of how much more you're going to get in tax refunds this year range anywhere from 125, let's say 150 billion. Consumers spent about $450 billion on gasoline and diesel last year. So if you get a 30% increase in the total gasoline and diesel bill for this year, that completely wipes out the benefits that you get from those tax cuts. And this is not, a judgmental thing. We're not saying things are good, bad, or indifferent, or the tax cuts should have been higher. Just in a purely mathematical sense, a 30% increase in gas prices, if it were to persist for the year, would wipe out the highest estimates of the benefits from the marginal tax cuts, and then you no longer get that boost.
Luke, just a final thought. I'm just curious, how tough is it for you right now to kind of model a forecast? Because in an environment where, Luke, listen, there's always questions, but right now it just feels so cloudy. I mean, we don't know when this war ends. We don't know when this oil disruption ends. I mean, there were some well-known economists, Luke, this week who were telling folks, listen, just don't put any weight on this dot plot this week. And I'm wondering how you think through that.
Yeah, I think I think there was a Federal Reserve chair who was saying, don't put a whole lot of weight on the dot plot. And I sort of agree with those economists. And Chair Powell said in the past, these things become stale with every passing day. And he was pretty explicit about that yesterday. He said, we have to write down a number. We don't want to skip forecasts like the one time we did it during COVID. And I think that they put those forecasts down with a lot of humility, saying, we don't know how this is going to turn out. The data and the prices can change, as they did today relative to yesterday in terms of gas prices. So I don't put a whole lot of stock in the dot plot. And, I'm not indicting anybody on the FOMC there. I'm going along with what they said because it's just very challenging. And we here at Wilmington Trust just have a different view on where the labor market is headed. And if our expectation turns out right, then the Fed is going to be cutting rates later this year, just like they did last year after a scare in the spring, and just like they did in 2024 after a scare in the spring. And that's what is going to end up dominating it is the labor market.
Luke, as always, great to have you on the show. Thank you.
Thank you.
Markets have taken a roller coaster ride just today alone as investors weigh the effects of the Iran war. Edward Jones CEO Penny Pennington gave a little advice for those navigating all this uncertainty.
Many of those playbooks are similar to what they have always been, which is understand your risk tolerance, your ability to deal with these kinds of up and downs and curveballs, because these will always happen. Understand your time horizon. How long do you have? Notwithstanding that we hope that this doesn't go on for a long time, we also know that there's always going to be uncertainty to deal with. So what is your time horizon? And then what are your goals? What are your hopes and dreams? It's important then to establish an investment portfolio that matches those things and that is well diversified. And right now, notwithstanding oil prices and prices that are going up, we also have some tremendous values in the market, ways for clients to take advantage of what's happening right now. But as we say, our financial advisors, 20,000 financial advisors, it's our job to take that anxiety off your shoulders, put it on ours, use those sturdy rules of the road, help you rebalance your portfolio, and stay focused on your world.
Where are you seeing those areas of opportunity now that the markets, I mean, look, the markets are not that far removed from their highs, but if you dig beneath the surface, there's a lot of sectors in the market that are in correction territory, and certainly in some cases bear market. I mean, look at software stocks.
Yeah. The lesson there is not to get wed to any one sector or to assume that any set of stocks is always going to go up. Trees don't grow to the sky. And so a well-diversified portfolio that takes advantage of those counter-cyclical movements is very important. Value stocks right now, the technology stocks had some tremendous days in the sun, and I think will continue to. But the promise of AI and generative AI, and we believe that there's a lot of promise there, the productivity promise there, might begin to transfer from the tech biggies to the companies who are going to utilize those tools to drive greater value and efficiency for their customers and their clients.
S&P 500's financial sector is on track here for a disappointing first quarter of 2026. Yahoo Finance's Inez Ferre joins us here with a closer look. Inez, I want to go through the story you filed today. It's a good piece. It's on private credit. And starting, there's talk here in your piece of yellow warning lights in private credit. Start there. What exactly is flashing?
Right, and that's what one strategist had told Yahoo Finance recently. It's the sort of yellow warning light. It's not a red warning light, but if you take a look at what Wall Street is saying, they're basically saying that, okay, there are these headlines that have worried investors. You are seeing redemption caps with some of these funds. And so they're saying it is a crack in the private credit industry that you want to be aware of. But this is not a systemic risk. What they're basically saying is that this is not a contagion that is going to impact the rest of the economy. You are so, though, seeing these prestigious firms that have been taking measures to sort of cap redemptions for some of these funds. I mean, you're talking about BlackRock, Morgan Stanley, Blackstone. And so the feeling is that this is going to be a concern, especially as you have a maturity of debt that's coming up. So this maturity wall that is of debt that was taken out about 5 years ago or 6 years ago, while you saw that interest rates were very low. And so that debt is now coming due. And so there's a feeling that there are going to be some defaults. And you've got Morgan Stanley that basically says that overall they're expecting direct lending default rates to reach 8%, approaching COVID peak levels. That's because you have some of this debt that is maturing, 11% of software loans maturing by the end of the year, and another 20% maturing in 2028.
Those redemption caps you mentioned a second ago, BlackRock, Blackstone on private debt funds, how unusual is that?
Look, I mean, you were talking about years where you saw these inflows going into these funds, and now you are seeing that you're looking at redemption caps that are redemptions of 8 to 9%. That's higher than expected, and so there is a feeling that, okay, we are starting. A lot of it also has to do with the headlines that are feeding on itself, on themselves, right? You see that, oh, this is happening, and so therefore it's almost like a domino effect. You have fear, and so therefore you have investors that are looking to redeem, and so now these funds are saying, well, hold on, we can't give it all at once, and so you don't want to run on banks, so to speak. But a lot of this has to do with software and what's been happening in the software space.
That's an interesting, important thread, AI and these AI disruption fears and how they're creeping into credit risk. Walk us through that.
Yeah, and that's because a lot of these private credit is exposed to the software sector. In fact, it's estimated around 20% has gone to software. So if you now have these concerns about what's going on in the software space as a whole with AI, you have concerns of business models that are going to be disrupted. You have concerns on the way the profits that are going to be shrunk. You have concerns about even the way that they charge on per seat. Now, how are they going to charge now if you have less people that are working? So it's an entire, we've seen what's happened in the software space. We did see a little bit of a bounce, though, and when you talk about software over the last month. I mean, we have seen some rotation going into that because Wall Street is saying it's a little bit overdone. It's a little bit overblown. Okay, yes, there's going to be some disruption, obviously, in the software space, but this is going to take time, and they will adapt and they will pivot. That you will see pivots within the software industry that is not going to be as bad as feared. At least that's the sentiment on the street right now.
And I guess bottom line, what we're talking about here, Inez, do you look at it and say, okay, this seems still kind of niche and contained, or no, this could sort of spill into something broader?
It seems to be niche and contained to the private sector space in general. Even when you look at what some strategists, some of these firms have been saying, is that when you're looking at the private credit space and how much they lend to companies overall, you're still seeing that it's not as large as other forms of lending. So it seems to be contained. But it is something that's given the market jitters. I mean, we're talking about it now, but we've really been talking about the war for and energy prices a lot more over the last couple of weeks. So it is something to be aware of, and especially as you see this debt that's maturing.
All right, Inez, thank you. Appreciate it. Shifting gears to the auto space, Uber and Rivian adding fuel to the increasingly competitive robo-taxi space in Yahoo Finance's Praz Submarine joining us. All right, Praz, let's start on that story. This knows about Uber, this deal, I'm just curious how it's structured actually, because this $1.25 billion, I mean, how much is that is sort of real money versus, hitting certain milestones?
Yeah, it's a lot of milestone stuff here. So, upfront, $300 million upfront, contingent on regulatory approval for about 10,000 of these robo-taxis, right? And the balance over the next few years for 40,000 more, and then you unlock that $1.25 billion, which is, this is a significant investment. We saw the stock pop a lot earlier today, sort of tailed off a bit as trading began. But yeah, this is a big deal for Rivian. It's sort of a bet on the new R2, and for Uber, it's sort of the next step in their sort of their Uber or robo-taxi plans.
So if you look at Uber, you got deals with Rivian, Waymo, NVIDIA, Lucid, right? What's the broader strategy here?
It's like they're spreading their bets across both the providers of the cars plus also technology, right? So in the case of the vehicles, it's Lucid, it's Uber, other manufacturers, right, that they're using for EVs, that they're using for their robotaxi fleets of their own, but also for their partners. They have partners that manage fleets, and they're saying, hey, use our platform, you manage the cars, right? But on the talking about the technology or software space, you have NVIDIA with both hardware and the car plus software. You have also a company called Neuro, which they're working with Lucid, right? So you have a bunch of different, and also Waymo. I forgot about Waymo. Like Waymo, you're allowed to basically book Waymo on Uber's app in certain cities, and they want to expand that too. So they're really spreading their bets across a number of providers. Maybe it's a way to sort of see who wins out, who has a better technology, how do we spread our money across that, and not ourselves being Uber betting on one particular thing.
We talked about, by the way, what this means for Uber. What was your take on what it means for Rivian? Because that seems like a big order.
It's huge, and you have a company like Rivian that's still chasing profitability, right? And they're scaling up the production of a brand new car that they think will be a volume seller for them. And this is a big shot in the arm in terms of capital to get that to work, get a little more runway to get the car up to volume, because they believe that once you get the car up to high volumes, then it'll be profitable for them, right? Because it takes time to kind of defray all this capital costs you put up, right? It's age-old story in manufacturing. But with Uber's sort of partners, Rivian's partners with, not just Uber here, but also Volkswagen, huge investment in the company, right? That also took them sort of past a sort of a runway there. So it's big for them in terms of just being able to defray those costs of development for these cars and have Uber be a huge buyer of a number of these vehicles.
By the way, another story you wrote about today, BMW officially unveiling its new i3 EV. What did you make of that, and how did you see it sort of compare and contrast with the Tesla Model 3 range, charging, performance?
So BMW's been talking about this. Their new like basically their second gen EVs are going to be based on a thing called the Neue Class platform. It's a brand new platform, supposed to be more efficient, better batteries, better driving apparently. So this car has been teased for a long time. We finally see it in sort of production form. And basically, we have a little chart here, compares very favorably to the Tesla Model 3, which is sort of the standard bearer for EV sedans. See that price, BMW i3 is going to be probably around $55,000. Not cheap, but a BMW 3 Series around that kind of money, right? So, but compared to the Tesla Model 3 Performance and Model 3 Premium, both of the all-wheel drive versions, because the i3 is all-wheel drive, you see that pricing not too bad, but you get a lot more range, 440 miles, which is a big deal for people from a psychological standpoint. Hey, I can drive this car all week and not have to charge it. I'm not afraid of that. So that's a kind of big thing. And I think the car looks good. It's not super aggressive. They almost made it a bit conservative, but the inside, I think, compared to Tesla, the inside cabin is much nicer. So you have a bit more of luxury there, a bit more premium feel there. I think that's kind of a big rival or at least competitor for the Model 3.
All right, Ross, thank you, buddy. Come up, we've got you covered with all the action following the closing bell. Stocks ending the day lower here, but paring back some of their earlier losses after Israel's Prime Minister Benjamin Netanyahu said it won't strike Iran's gas fields as the country can no longer enrich uranium. Netanyahu also saying Israel will work with the U.S. to open up the Strait of Hormuz. Our very own Jared Blickery with us live from New York Stock Exchange with what he's hearing about this on the floor. Jared.
Well, thank you, Josh. Look, we got a mixed day here. Looks like things could have been worse, and I think that's kind of the attitude I've heard from a lot of people. But that Federal Reserve meeting yesterday is probably more important and a little bit more hawkish than a lot of people are giving credit to. And you can really see that in the gold market. Gold just it cracked 5,000 the other day, and it just had one of its biggest sell-offs since the Goldmageddon at the end of January when we had silver down some tremendous percent. My point is that these things are working themselves throughout the market, and it looks like tighter financial conditions. You can also see this in the US dollar index, which is pushed above 100, and it's been hovering around there. So a stronger dollar is not necessarily risk on. We've seen it hurt countries, stock markets all around the world, but it also weighs on international stocks, on commodities. We've seen that in crypto. And in general, we've seen markets kind of sell off in the beginning part of the day or open lower, and then sometimes claw back gains. So it hasn't felt that bad, but we keep losing these levels. The S&P 500 open to, what was it, fresh 6 9-month highs this morning, and if not those, then flirting with 9-month lows, not highs. So this market keeps taking out levels, and you're wondering, when does it stop? So we haven't seen any panic selling by any extent, but we haven't seen the most bullish price action either. If you take a look at the sectors that have been leading in March, it's only one that's green, and that is the energy sector, and that's because crude oil is now triple digits. Everything else in the red. And the tech trade itself has been broken for a number of months. We saw some weakness off of Micron, and really that did not translate into a broader chip sell-off that you might have thought. So that actually wasn't that bad. But software has been the real boogeyman in the tech trade. That peaked last September, October, and it's fought at various times to come back, but those have been nothing more than short-lived, short-covering bounces. So until we see some real leadership assert, and I'd like to see it in maybe something bigger like the industrials, or tech would be ideal, energy alone cannot carry the trade. So I think this hawkish Fed reaction, kind of postponing any hopes of Fed interest rate cuts, that is a big deal, and it's probably not fully priced into the market right now.
All right, thank you, Jared. More on the latest market action is Cole Smead, the CEO of Smead Capital Management. Cole, great to see you, especially on set. I want to start with the energy sector and your views on that sector, because you've been kind of pounding the table on that, Cole, for a while.
Yeah.
And I know you think even here, you say investors might be underestimating this sector. How come? Walk me through that.
Yeah, I mean, the low of the sector was 2020. I mean, the spring of 2020, that was a generational low. Mm-hmm. The second major low of that space was last spring. So just think of last April. We had tariff concerns, tariff fears, running amok in the idea of what the economy is going to do. But OPEC Plus also came back and said, hey, we're going to supply more to the market. Mm-hmm. And that was thought to be a nightmare for the industry. So the low came in the spring, and throughout the year, those stocks have been picking up. And the whole idea psychologically for market investors was, A, it's 3% of the S&P 500. Mm-hmm. Therefore, to quote the Monty Python, 'tis merely a flesh wound. Secondly, is that you had the presidential administration saying, we're going to just drill, baby, drill like we did back in the 2010s. But when you talk to the producers, they had no interest in doing that. So you kind of put this all together. You had incredibly low sentiment with this idea that the future's very known. Future's known in things like AI capex and the fact that we're not going to need that much production of energy in the future. And what we've woken up to a world where if you want to buy oil in Oman or Dubai right now, you're going to pay $170 a barrel. Never seen before. And so it's so funny to go in the equity markets from this world where we thought things were so known too quickly, how fairly unknown the future is again.
And do you see this as sort of, hey, this is a multi-year structural setup for energy stocks?
Yeah, so back to your point. So the low, like I said, 20 and then last spring. But we're coming out of an era where household ownership of equities has been off the charts, 54% among US household financial assets. What tends to coincide with that is bad markets going forward. And conspicuously, what comes out of that is usually energy stocks do very well in that era. Now, is that all you can hang your hat on? No, I mean, we have these businesses that used to drill, baby, drill and waste a bunch of capex. 2020 and the years after with 2022, they really cleaned up their capital structures. They're very, shareholder return focused. And even despite all those good things coming, what's the investor, takeaway been? Who cares? Right? Now we're in an environment, a world where investors are stopping and saying, wait a second, maybe I should care about this a lot more. And your viewers should remember that Yom Kippur, the war of 73, it only lasted 30 days. But the effects were felt for years later in the 1970s. We are, over 2 weeks into this saga. There seems to be no end in sight, but even if it's only 30 days, it could be just as damaging. In that prior era, as an example, greatly rewarded energy investors and S&P 500 investors, or just stock market investors in general, didn't do well during that time.
And I want to get to some of your picks you have in this space, but first, just turning to another sector, another theme, the AI theme, right? Yeah. I know you actually see some parallels between the AI boom now, the dot-com bubble. What are they?
Yeah, the primary similarity would be what happened in the telecoms in the late 1990s. So you think of like the WorldComs, the Nortels, the Lucents, and then the AT&T and Verizons. The Telecommunications Act of 96 came about. There was a massive wave of mergers, and we were going to build this internet out. Now we did, except the rate of adoption and the returns on capital ended up being high on rate of adoption, but slow, and returns on capital were very low. If you look at what's going on in the hyperscalers, it's very similar to the drill baby drill or that era. Lots of investment, lots of capex. In the oil businesses, 12 and 14 were the highs. But what came out of that is the future's unknown. So the returns were much lower. In that case, they used borrowed money as well, like the telecoms did. The difference this time is we're seeing a lot of off-balance sheet financing. So Meta's building these projects, packaging them off, selling them to third parties. It's still off-balance sheet financing, and yet Wall Street is going along with this game saying, okay, they're still going to produce really high returns on capital. Well, we don't know that, but the multiples are set up for high returns on capital. If those returns don't come in, we're going to find a world where they're going to get a lot lower multiples, and they've built up all this book value in capex, which again follows all the other paradigms. Here's the big idea. Is there a big difference between a computer science engineer and a petroleum engineer? And the answer is no, they're both human. But conspicuously, we look and say, oh, they're vastly different because one's smarter than the other. We'll find out.
Do you go as far, Cole, to use the word, the bubble talk? This is an AI bubble, however you want to define that term?
I look at this as a capex mania, right? When oil got beat up in the 2010s, did that hurt some investors? Yeah, there's a lot of value people that got hurt, and the market got hurt off that. This is big in the market exposure, so someone could call it a bubble. I just say that because these are just very normal parts of capitalism. By the way, as someone that doesn't participate, is this annoying, frustrating, tiring to sit through? 100%. But it's normal. And that's the worst part. So I think this goes under the heading, as I said to someone earlier today, Munger always talked about ignorance avoidance. Not participating in that capex mania is ignorance avoidance. What do you really do? You're just saving yourselves problems. That doesn't tell you what to own necessarily, but in investing, knowing what not to own is just as powerful as what you should own.
Let's get to some picks here before I let you go. APA, this one has had a run, Cole. It's it's already up around 60% this year. It's up around 80% over the past 12 months. Walk me through how you like it.
Yeah, so this was a stock that was left for dead last spring. It was at $14 a share. You're looking at it in the mid to high 30s today. Here's what's going on at APA. APA is an incredibly good capital structure. They got a 13-year average debt duration. They're paying 5.5%. Wouldn't you and I like to borrow that kind of $5+ billion of money? They've been very rewarding to their shareholders, buying back stock, been smart with when do we want to drill in tough environments and when do we not. I think they're a buyout candidate. I think the majors could come in and buy them. I think another company we own like Oxy could come in and buy them. Because ultimately, if you wanted to extend your debt duration, their capital structure is a way to do it. And those bigger players could take out the entire market cap of the business. If you look at their SG&A on their income statement, it's about $350 million. Here's what I've learned in capital-intensive businesses. The buyer comes in and says, yeah, we can take that to zero. And that's the history of this. So put a 5 to 10 times pre-tax multiple on that, and you get about $2 billion of value just there before you go out to look and find other places that maybe you can add value.
What about Cenovus, which, by the way, has a similar chart to APA? I mean, big moves year to date and over the past year.
Yeah, so Cenovus is a big oil sands player. They just bought out a company we also owned last year called Meg Energy. So just think traditional oil sands, long life assets. We're talking like a 30+ year asset base. And so just think of this world where it's like, is Canada our friend or not? Or, we debated all that around. Well, the United States and really North America has a major advantage today. We have this beautiful resource to our north, and we have this beautiful resource. So unlike 1973, where we did not produce our own oil, this is America's day in the sun. We are the largest oil producing nation in the world. Canada is a major oil producing nation, and we have absolute security in that supply of oil. Like, this is so much better. The future's so bright. And yet, the main problem is the investors that don't own these securities and are benefiting from what's going on in them. They're looking from the outside in saying, what am I missing? But from an economic perspective, this is so vastly better because these are problems for other parts of the world. We have energy security the way we've never had before.
I want to get you out of this because this is not a name I was familiar with. Strathcona Resources.
Oh, it's a great name. Yeah.
How so? Walk me through the bull case.
So again, another oil sands business. Your viewers should go check out the gentleman that started this business, a guy named Adam Watrous. He's the executive chairman of the business. It's a business based in Calgary, just like Cenovus is. But he's built up this great oil sands business, over 100,000 barrels of production. They're going to go to about 200,000. So the word I'll leave you with is the word torque. This market is set up in a way where as prices rise, who gains the most free cash flow and operating leverage off that? And Adam is one of the more bullish people out there, and therefore he's being rewarded for that. I mean, that stock looked like it's done really well. They paid a $10 special, like right before the end of the year. Very shareholder-friendly, folks. It's an excellent name. It's only traded in Toronto, but it's a name I really think investors should check out and take a look at.
Cole, so good to see you, especially on set. Thank you, sir.
Yeah, good to see you.
Coming up, we break the latest earnings report from FedEx. Don't go anywhere. FedEx third quarter earnings just now crossing the wire. Let's get you those results. So Q3 adjusted EPS, $5.25. That's versus consensus of $4.17. That's a beat. Q3 revenue, $24 billion. Consensus was $23.49 billion, also a beat. Importantly, looking ahead here, they are now seeing full year adjusted EPS. They're calling for between 1930 to 2010. They had seen between 1780 to 19. So they do lift their profit outlook there. Full year capex up to $4.1 billion. They had seen 4.5. The street was at 4.3. You can see the shares up about 1.5%. Why pay close attention to FedEx? Because it is still seen as a kind of economic bellwether, the way it moves goods across the country and the world. Plenty of questions for FedEx heading into this, how it's navigating and just sort of thinking about any number of important cross currents. Obviously, geopolitical conflict, oil prices, the Supreme Court's decision to overturn the Trump tariffs. Remember, FedEx suing for recovery there. And also, it'll be interesting on the call just to hear about where the execs see demand strength and weakness in which markets. In a preview, the team at Evercore told a client they were seeing strengthening in retail sales and China exports. The drag effect in others had become less severe, like industrial production. Three, of course, you also have the separation of the freight division. Remember, that spinoff should be done by June. The stock's been interesting here because heading into this print, it was up about 20% this year. It had been down, though, about 10% since the war with Iran started, up about 2% right now in the after hours. Well, the so-called sandwich generation is facing financial hardship. According to Pew Research, 15% of adults in their 40s and 50s are supporting both a parent and a child. So how can those individuals find some relief around tax time? Joining me now as part of our Write It Off or Nice Try segment presented by H&R Block is David Perez, the CEO of Tax Maverick. Let's start right there, David. Can taxpayers get a credit or a deduction, my friend, when claiming dependents? What do you say?
So, well, we all want credits, by the way. Credits actually lower your tax liability, and deductions, well, they just reduce your taxable income. So we always want credits before deductions, but getting dependents on your tax return, or placing dependents on your tax return, rather, are able to get you credits, and that's what we want. And so there's child dependent care credits. There's credits for people who you claim on your return. That could be a parent as well.
Next one. How about this? The child tax credit, and how does someone qualify for that, David? Walk us through it.
Well, that's a great question. So this is usually when you think children, you think young children. It's a child that's under the age of 17 that lives with you or is part of your family. They have to be a relative, and they must be claimed on the return that you're about to file. And so this year, it's $2,000 for a child. Part of that is non-refundable, and some of it is refundable, which means if it's non-refundable, it means it can only take you to zero. And if it's refundable and you're not owing any tax, you can actually get a refund of up to $1,700.
What about this one, David? Can you write off child care expenses?
Yeah, you can. Actually, child care expenses is one of the best deductions because it doesn't phase out like most of the other credits at a very low level, like meaning higher income earners can use this. And you can use dependent care credit or dependent care expenses such as like daycare, after school programs, or babysitting services, all of which are tax deductible on your tax return and can get you a credit back of up to $2,500.
What about, Dave, home health aides or retirement community costs for an elderly parent?
So if you have a parent, this is a good one because most of us have elderly parents. They're requiring more and more, caretaking. And if they're required to have these caretakings either in a home care facility or a home-based facility, and they have maybe some adaptive equipment like wheelchairs or anything that could help to meet for mobility or for just a way of living, all of those can be deducted on the tax return under Schedule A. The only caveat here is that they have to exceed 7.5% of your income, which can be a lot for high-income earners, but if you're taking care of a parent or you're using medical devices, man, this could be a great tax deduction.
Can you deduct, David, medical expenses for child or parent?
Both, actually. Both can be deducted, but they still have the same limit, 7.5% of your AGI, your adjusted gross income, which, again, as your income gets higher, it becomes a harder number to hit. But, of course, if you are taking care of these large bills, because we know healthcare is expensive today, this could be an easy way to get a tax deduction.
Finally, David, just broadly, what other tax benefits can we take advantage of if we have dependents? What would be on your radar?
I would look at things like educational expenses, especially if you have older children, maybe going into college. You can use the American Opportunity Tax Credit or the Lifetime Learning Credit. These are two big credits that I think most are overlooked by parents, especially if you are a higher income individual. You probably don't qualify for, let's say, financial aid or government assistance programs or scholarships in some cases, not even. You can actually get these credits and they would give you a refund on your tax return because they are refundable credits. And so I think that's probably the one that I would say is most overlooked by people today.
David, great to have you on the show today. Thank you.
Hey, thank you for having me.
Time now for what to watch Friday, March 20th. Major story, we're tracking your energy markets on edge as conflict escalates in the Middle East. Crude pushing higher after key energy infrastructure in the Gulf came under attack on Wednesday, before stabilizing again following comments from Israel's Prime Minister Benjamin Netanyahu signaling the war in Iran will end faster than people think. Markets are also reacting to damage at refineries and processing hubs, which would directly impact things like gasoline, diesel, and jet fuel. That pressure already showing up for consumers. The national average for gas is now sitting around $3.90 a gallon, with some analysts expecting prices to move above $4 as soon as next week. Diesel prices are already above $5, a signal this could feed more broadly into inflation and transportation costs. Investors will be watching whether this is a short-term volatility or a sustained supply shock. Key things to monitor: the status of the Strait of Hormuz, any further attacks on infrastructure, and how the U.S. decides to respond. Turning to earnings, Chinese EV maker XPeng is reporting fourth quarter earnings on Friday. Analysts expecting the company to potentially reach break even for the first time, driven by a richer product mix and growing tech-related revenue, including partnerships with Volkswagen. Big picture for investors, growth is relying on new model launches and advances in autonomous driving, while longer-term bets like robotaxis and AI remain more of a future story than a near-term earnings driver. Coaster ride just today alone as investors weigh the effects of the Iran war. Edward Jones CEO Penny Pennington gave a little advice for those navigating all this uncertainty.
Many of those playbooks are similar to what they have always been, which is understand your risk tolerance, your ability to deal with these kinds of up and downs and curveballs, because these will always happen. Understand your time horizon. How long do you have? Notwithstanding that we hope that this doesn't go on for a long time, we also know that there's always going to be uncertainty to deal with. So what is your time horizon? And then what are your goals? What are your hopes and dreams? It's important then to establish an investment portfolio that matches those things and that is well diversified. And right now, notwithstanding oil prices and prices that are going up, we also have some tremendous values in the market, ways for clients to take advantage of what's happening right now. But as we say, our financial advisors, 20,000 financial advisors, it's our job to take that anxiety off your shoulders, put it on ours, use those sturdy rules of the road, help you rebalance your portfolio, and stay focused on your world.
Where are you seeing those areas of opportunity now that the markets, I mean, look, the markets are not that far removed from their highs, but if you dig beneath the surface, there's a lot of sectors in the market that are in correction territory, and certainly in some cases bear market. I mean, look at software stocks.
Yeah. The lesson there is not to get wed to any one sector or to assume that any set of stocks is always going to go up. Trees don't grow to the sky. And so a well-diversified portfolio that takes advantage of those counter-cyclical movements is very important. Value stocks right now, the technology stocks had some tremendous days in the sun, and I think will continue to. But the promise of AI and generative AI, and we believe that there's a lot of promise there, the productivity promise there, might begin to transfer from the tech biggies to the companies who are going to utilize those tools to drive greater value and efficiency for their customers and their clients.
Hello and welcome to Asking for a Trend. The recent sell-offs in markets is exposing potential vulnerabilities for those saving for retirement. To dissect what you need to be on the alert for, let's welcome in Pam Kruger, founder and CEO of WealthRamp. It's a platform that connects people with financial advisors. Pam, it is good to see you. So you say broadly, Pam, the market environment we're in right now exposes these blind spots, right? So let's talk about those. The first blind spot you talk about, the market changed, but your portfolio hasn't. And it seems like, Pam, in this, you're really focused on concentration risk. So walk me through it.
Yeah, because right now we've got the markets being pulled in multiple different directions all at the same time. And, there's so much risk. And the market's being driven by AI, interest rates, potential for higher inflation, geopolitics. Okay. And for people who are getting closer to retirement, the real risk here might not be trying to pick the right trend. It's not realizing how exposed you are already to the trend that's already been happening. So what I mean by the market's changed, but your strategy hasn't, think about all of the do-it-yourself investors out there who do a great job, as individuals, managing their own portfolios. And, maybe they've been in an index fund very smartly, low cost, they believe that they're well diversified, right? But then they don't realize that index fund over time, has shifted. And now you take a couple, who might have, one couple I'm thinking of that's their clients, 2 401ks, 2 careers, did everything right. They have $1.6 million in savings. But when their financial plan was stress tested, nearly 40% of the retirement savings was tied to the same handful of mega cap stocks. So you believe that you're diversified, but you're actually at real risk of having, a high concentration. And if you're in your 20s and your 30s, it might not be that big of a deal. But when you're talking about you're in your 50s and your 60s, you don't have as much time to recover from a major drop. So I was talking to one of our advisors in our network today, Jeff George in Orlando, and he pointed out to me, it's really hard to do this kind of looking at, you're taking an unbiased look at your strategy yourself and being able to say, oh, yes, I haven't been invested in metals enough. I haven't been in mining companies and energy companies because the index that I've been in has had extremely low exposure to those areas. So there's been no inflation hedge whatsoever. So while you've been believing that you're, really well diversified, you've got to look at the top 10 holdings inside your largest funds. And you've got to see if those same companies, all together are still going to work on your timeline, if there's a big drop in the market. And are you looking at the future and how to position yourself well for a real strategy going forward? Because if you look at the context for the past few years, you're looking at markets that have gone up, 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 up. And people are just so used to that and interest rates being low. And those conditions changing means your strategy has to change when you are getting closer to retirement.
Pam, blind spot number 2, let's hit this one. Believing the headlines are the biggest threat to retirement. And your survey shows, for example, advisors are more worried about overspending and debt than markets. Why is that so important right now? Threat assessment.
Yeah, this was pretty cool. We actually did a survey of our advisors' clients and our advisors talking to prospects. Right now, it feels like the risk is out there. It's geopolitics, it's inflation, it's the Fed. But sometimes the blind spot's not out there. It's inside. 33% of the respondents, the advisors who responded to our WealthRamp survey said, 33% said people coming to them looking for advice are really overspending and they don't realize it. Their lifestyle is at risk in the future because they believe that they're on track. So they kind of, people have a tendency, we all do, to drink our own Kool-Aid. Only 21% said that market volatility was the biggest threat. These advisors are seeing this trend, that people are not looking and stress testing their own spending and their own guardrails. to make sure that as they head into retirement, not only is it concentration risk and the market drops 20%, but are you going to be able to do the things you need to do to be able to sustain and not run out of money in retirement? So it kind of you have to look inward and ask yourself, have I truly stress tested, and am I really up to the task of stress testing my own plan? That's the question right now.
Final blind spot here, Pam. I am too far behind to fix my plan. In other words, you're seeing folks who think I missed my window.
Again, this is amongst pre-retirees, and this is one of the most common and the most damaging beliefs that advisors see right now from prospects coming in. In our survey, about 1 in 5 advisors said that pre-retirees wrongly believe that they don't have enough money to retire. And when they sit down and they understand adjustments that can be made right now, they see two things. Wow, either I'm in better shape than I actually knew and I actually thought, or, okay, I'm off, but I can make some adjustments because there's still time. So, some of the things that people can do is build a bridge to retirement. Why does retirement have to be an all or nothing proposition? Flip the switch. You're either working and earning income or you're not. Build a bridge. Either work a couple more years or pick up some part-time work, but keep bringing in income. I mean, think about $1 million saved. Somebody who's 62 and they're thinking about retiring right now, but they're not quite sure. They work an extra 2 years, even at modest returns. That $1 million could be 1.2 million. That's an extra $150,000 or $200,000 in a couple of years. That could translate into thousands, more in annual retirement income when the time comes. So there are levers you can push and pull. Obviously, catch-up provisions. This year, I think that you can top out as much as $40,000 a year if you can do it and you're trying to play catch-up. So there are tools that are there, but I really think that the big message for me is that people need to, if they do want help, they need to get that help from a fee-only advisor who's truly working only for them as a fiduciary, so that they really get objective answers, and talk to advisors who are not going to tell you what you want to hear. They're going to tell you what you need to hear and add value.
Pam, so good to have you on the show today. Appreciate that advice and guidance. Thank you.
Thank you.
Coming up, our very own Ben Worschel diving into the cost of this war in Iran.
As far as $200 billion, I think that number could move, obviously. It takes money to kill bad guys.
The cost of the war in Iran has been quickly becoming a major flashpoint in Washington, with Department of War Secretary Pete Hegseth commenting on the importance of more funding.
As far as $200 billion, I think that number could move, obviously. It takes money to kill bad guys.
For more, we're bringing in Yahoo Finance Washington correspondent Ben Worskell. Ben, great to see you. Maybe start there, Ben. This number, this bogey, $200 billion. I mean, when you heard that, Ben, did you think trial balloon or no serious number? And what would go into that $200 billion? What does that imply, Ben, about timeline and escalation?
Yeah, good to be with you, Josh. So this number is definitely what exactly. I don't know that we're going to see this $200 billion at the end of this process, but this is a much bigger number than people expected. It was, as of yesterday, a lot of the guesswork here was what's called a war supplemental for $100 billion. So this is twice that. This number kind of first broke last night in a report in the Washington Post, and it's been a big topic of conversation here in Washington all day today. As for the reality of it, you heard from that clip from Secretary Hegseth there is some wiggle room here. $200 billion could move. He didn't say down. He suggested it could move one way or the other. But I do think the Trump administration is serious about a big number here. That's what we've seen today. We've seen endorsements of this on camera for both the secretary and from the president today. We don't have an exact breakdown of what this is, and they're talking about this kind of as a larger refilling of U.S. munitions reserves. But I think the reaction we're getting today is about what this tells us about potential duration, or at least how the administration is thinking about this. For context here, a previous estimate for the administration of the costs after 6 days of war gave a cadence of about $2 billion a day. That's a lot of money, obviously, but $200 billion is a much bigger thing than folks were expecting there. It also comes, of course, as the administration's endgame for this war is very much up in the air. We kind of saw that similar back and forth of the administration's messaging today. On the one hand, Trump saying the Iran is decimated and it's over, but he refusing to give a timeline. This is sort of one of the hardest numbers we've seen here about how they're thinking about this war, and it's getting reaction because of how big it is.
How unusual would it be, Ben, to see a supplemental request of this size?
It would be notable. I mean, this is notable. If they do this in one fell swoop, it would be notable for how big it is. This number represents more spending than was spent on U.S. aid to Ukraine all over the last 5 years from 2022 on. And that came in multiple supplementals. That came kind of multiple pieces, $80 billion supplemental here. $200 billion would be a big number and above all of that spending put together. So it's very big. That's part of the reaction here. Again, we'll see what it comes to in the end. Historically speaking, this is less spending than other wars. The Iraq War, for example, that when you measure costs there, you get into sort of the trillions of level here, even before the after effects of it. But this is a much bigger financial commitment than I think the Trump administration has been signaling for the weeks now so far into this war.
We are hearing some pushback, Ben. Let's say it is $200 billion. Does that get approved on Capitol Hill?
What we know for certain, we heard a lot of skepticism all day from the Hill, even from Republicans, even from some of Trump allies. Speaker Mike Johnson had a comment that I thought was notable. He was asked to endorse this $200 billion, and he wouldn't do it. He said, "I want to see more details. I support the troops. I want to help the troops. I approve that." But he wouldn't support this $200 billion. That's partly because we just don't know exactly where this money is going and how the Trump administration came to this. This kind of number is just, it's out there on its own for the moment. Well, presumably there'll be more there going forward, but we're seeing a lot of GOP skepticism here of the size of this number, especially considering there's a lot of folks in Trump's base that are negative towards this war been there from the beginning. So it's going to be a slog on Capitol Hill. Democrats, I should note, are kind of a sort of absolute no on this. This is the same position they had yesterday when we thought this number would be $100 billion. At the end of the day, though, I think even with all this skepticism, there is going to be a big price tag for this war, and it's going to have to get through Congress one way or another. Speaker Johnson, Majority Leader in the Senate, John Thune, also have a lot of different ways to get this done. So there's going to be a big check that Congress is going to have to write for this war. It may not be $200 billion, but they have a few ways to get it done in the months ahead for certain. So it'll be big one way or the other.
Ben, great to have you on the show. Thank you.
Thanks.
Coming up, Gary Cohn talks the impact of the Iran war on American consumers. cost of living is on the rise as higher oil prices filter through companies' financial statements. Yahoo Finance's executive editor Brian Sozzi sat down with IBM Vice Chairman Gary Cohen to talk this and a whole lot more.
Gary, good to see you. Great. I love that you always come prepared. You got the dot plot here. I mean, that's why I love having you on.
You know, it's very nice geometric shapes.
No, it's
so
great.
I thought I'd bring it in.
No, it's awesome.
In case we want to talk about the geometry.
I also love talking to you because you talk in, you make a lot of sense to me every single time. So we heard from Chair Powell yesterday. He didn't want to commit to how higher gas prices are going to impact the economy. For the average human out there, is what we're seeing with oil prices transmitting to gas prices, is it recessionary?
It's absolutely recessionary in the short term. Like, there's nothing more instantaneous to a consumer than standing there holding down the gas nozzle and watching the numbers tick on the pump. You know, every consumer in this country knows exactly what they paid the last time they filled up their tank, what they paid a month ago. And if they were paying $80 a week ago and they're paying $85 this week and they were paying $60 a month ago, they know that I lost $20 of disposable income in filling up this tank of gas. And unlike people who live in New York City, the hardworking Americans in this country, they drive a lot of miles. They can fill up their tank 2 or 3 or 4 times a week. If you're filling up 4 times a week, that's $80 of disposable income coming out of your pocket, after-tax disposable income. That's the difference between taking your family out to dinner and not taking your family out to dinner a couple times in a week.
When does this start showing up in economic data?
I think we're starting to see it come through. Remember, we're sort of week 3, going in maybe week 4. It takes some time for the transmission mechanism to work its way through the system. The other thing that you need to understand, and you do, we in the United States, we're actually in a pretty good position. We don't have a supply issue. We have all the supply we need. In fact, we're exporting natural gas, we're exporting oil right now. The rest of the world actually has a price and a supply issue. So we know we've got the oil here, we know we've got the natural gas here. If you're in Asia or you're in Europe and you're running a government there, you're making really strategic decisions how you're going to use the oil and gas that you have. And in fact, parts of Asia right now are shutting down businesses, closing down schools, asking people to work from home, and doing all the things you would normally do to start saving and economizing on the amount of oil you consume. So in many respects, we're in a better position than most of the world right now.
I'm going to get this question, so I'm going to put it to you before I get out there on X. Are we in a recession, or we are slowing down going into one as we speak?
I think right now, we're more in a stagflationary environment. Gotcha. We don't have growth, but we have prices increasing. Now, look, the prices increasing could be relatively short term, but we don't know. The one thing about being in a geopolitical situation is you don't know when geopolitical situations change, how quickly they can change.
There's no line of sight to when this is ending.
There's no line of sight. And we are seeing businesses on the other hand, and we saw this before what's going on in the Middle East here. Businesses were starting to right-size themselves. There was this natural squeeze on profitability. So you can go back to the quarterly earnings reports a month ago. And in those quarterly earnings reports, a lot of major companies were talking about 30, 40, 50,000 layoffs. There was hundreds of thousands of pronounced layoffs in last quarter, which was Q4 earnings that are coming out now. So this trend to cut labor cost in companies has been going on for the better part of almost 6 to 8 months right now. And it's a natural phenomenon. As companies have input costs go up, commodity prices have been going up across the board prior to this war. We see labor costs going up. If you have commodity prices going up, labor costs going up, tariffs going up, you have 2 choices as a company. You either raise your prices or you find a way to be more efficient. Companies had been hesitant to raise prices initially, so what did? They got more efficient. They started laying off people. And most companies literally came out of COVID with a bloated workforce. When we were in the early 2020s and people were working from home, we weren't sure how much productivity we were getting out of our workforce.
Let's keep everybody on the books.
Right.
Yep.
So let's hoard employees.
Yep.
So if I need an extra 20% employees to make sure I can deliver to my clients, it's okay, because right now I can charge for it. And look, we're in a time of crisis. I don't know where to hire the next person. So we went with people hoarding employees in the 2023 cycle. Then we get into this new cycle of higher input costs, and all of a sudden people realize, okay, people are back in the office. They're working 5 days a week. The productivity has gone up dramatically. I can now get done exactly what I need to get done with less people. And look, let's be honest, AI is coming in, AI is creating some of the efficiencies as well. But I don't think AI is the driver here in companies really downsizing employees. Right?
What you're saying makes a lot of sense. And at what point is it another 2 weeks, or how many more economic signals does the administration need to get before they say, you know what, let's just wrap up this war, we got to get back to growing the economy?
Yeah, look, I think the administration is acutely aware of the economic issues going on. I know that the economics will have some input into their decision making, but at this point, they're sort of committed to what they're doing, and I think they have to finish what they're doing. There's no reason to get 90% there and withdraw at this point. Let's just finish this off once and for all. We will get back to a normalized recovery. It will take some time. You know, one thing about recovering the oil market and the natural gas market is, you know, it's not a day out, a day to get back. If every day you're out, you know, you add more and more days to recover.
So the economy doesn't just snap back.
We're not going to snap back. That said, if we know that oil can freely move through the Straits of Hormuz, and we know that it's available, and it's just a timing of getting wells back up and getting some pipelines fixed and getting some motors fixed and replacing some of the damage, the psychology of knowing that's happening will probably affect the market more than the actual shipping of the barrel. You know, it's always trade the news. The actual event's not that interesting.
I'm glad you're here because I want to talk about AI too. The clip we had coming back from the show, I talked to Circle CEO Jeremy Allaire at the New York Economic Club, and he was saying, look, we're like 6 months away from a massive change in the labor force because of AI proliferation and a spike in unemployment. Like, do you see that, and how bad could this get, and how quickly?
Like, I don't know about a 6 month of anything. So making these predictions on 6 months.
You scared the
here's
shit
about this. I'll make a bold prediction. I don't think he's right.
Yep.
It could be 4 months, could be 12 months,
sure.
But 6 months.
But it's coming.
Like, it's coming in some respects, yes. But there's also new opportunities being created. You know, the one thing I always point out to people, if you go back in the history of this country, go back in the history of the world, go back in the history of this country, and show me a major technological advancement that didn't overall grow levels of employment. Because when you create a major technical advancement, what do? You create productivity. When you create productivity, you create a larger economy, you create a larger GDP, and we need more people. Now, we may need them in completely different jobs. So, you know, back in the cotton gin days, we needed people picking cotton and sorting it. We don't need those anymore. Back in the horse and buggy day, we needed people managing stalls, shoeing horses, feeding horses. We didn't need that. But lo and behold, the internal combustion engine came, and we needed people fixing those internal combustion engines. And in fact, there were a lot more internal combustion engines than there were horses because the economy grew. Sure. Even when you get back to the internet, you know, I remember when we got internet and we got email. And everyone looked around the floor of the office and said, well, what are all those people going to do? That person there prints memos, puts them in my mailbox, and tells me what time to be at a meeting today. Well, that person's job lasted about an hour when I got an email. But every company that got email is probably 2 or 3 times bigger today because they have a much bigger geographical footprint, because now I can talk to you real time on email. I can communicate across the world. So, look, I'm not saying there won't be just some disruption. There will be some disruption in employment. But I think at the end of the day, we will need different skills, and we will continue to need people to make sure our economy grows.
What happens to the displaced humans? I've heard some folks, they've just told me, Brian, we need some form of universal basic income for displaced AI workers. And is that even a possibility?
Look, I think displaced workers will be retrained, and they'll get other jobs. They were talking about things like this when the horse and buggy went out, when the internal combustion engine came in. They were talking about things like this many times in the event. There's always this natural reaction that it's going to be horrible, it's going to be bad, it's going to be the end of civilization, it's going to be the end of the way we live. It's not. It's going to be different. And you know what? Different could be a lot better. If the economy grows dramatically, you know, we are going to need a lot more service people. You still can't use an AI machine to fix my sink, fix my lights.
No. You see those robots in people's kitchens.
Well, but try and get a plumber in the city.
Yeah.
Try and get a plumber anywhere in the country. Try and get a carpenter. Yeah. Try and get an electrician. You know, these are skill sets that are still going to be needed. And think of all the building we're doing of data centers. Think of all the building we're doing of power facilities. They're not going to be built by machines. They're going to be built by human hands. We're going to need hands that are trained.
That's a wrap on today's show. Thanks for watching.